Individual landlords and investment groups alike turn to DSTs to replace their rental properties. Most individual investors will reinvest all of their equity into DSTs, while larger investors may use them in a mixed portfolio. Many investors are looking to transition from active management to passive ownership. DST investors often seek to escape management hassles, tenant troubles, regulation burdens, declining yields, increasing taxes, looming expenditures, and legal liability. A Delaware statutory trust is an investment trust formed under Delaware law to establish a pooled investment company or fund. You may have already invested in a DST and didn't know it, as many mutual funds and interval funds are formed as Delaware trusts. DST investors hold beneficial interests in the underlying assets of the trust. They are not on title, but the IRS regards them as the property owners. A 1031 DST is formed to own one or more investment properties and then raise capital from hundreds of investors who need to replace the real estate they sold in a 1031 exchange. The investments are designed to qualify as like-kind real estate under the Internal Revenue Code. DSTs are the only example of indirect interests in real estate that qualify as replacement property in a 1031 exchange. This comes from an IRS ruling in 2004. Under IRS rules, a 1031 DST must invest only in real estate with only one lease, only one loan, only one round of investors, and only one portfolio of properties. All net income must be distributed to investors with no expenditures for major improvements. Attributes of DSTs typically include passive ownership, built-in no-application non-recourse financing, institutional management, potential for diversification across property types, locations, and tenants, potential for monthly or quarterly income, limited liability, fast, transparent process with no escrow, and customizable, flexible investment options. The most popular properties inside DSTs are Class A apartment communities, but DSTs also include retail, industrial, medical, and self-storage. In a typical 1031 DST offering, the DST will raise $20 to $40 million from investors, with another $20 to $50 million of debt. Of course, some DSTs have no debt, but most have between 45 and 60% loan to value. If you had a loan on your rental, in a 1031 exchange, you must replace that debt, either with a new loan or with cash from out of your pocket. In a 1031 DST, you can claim your pro rata share of the program's built-in loan, despite having no personal contractual obligation to the lender. (1031) DST investors are truly along for the ride, with no control over property management, leasing, or disposition. If you still love rolling up your sleeves and working on your properties, DSTs are not for you. Simply put, 1031 DSTs are more expensive than traditional real estate, yet investors potentially receive value for such cost, including but not limited to sourcing real estate from among thousands of listed properties, conducting intensive property-specific due diligence and preparing complicated financial models, securing optimal financing terms, engaging top property management companies, or in some cases utilizing in-house property management, providing ongoing accounting and tax reporting, monitoring the property and the market to optimize disposition timing, and years or decades of institutional experience. In exchange for these services and potential benefits, investors pay acquisition fees, asset management fees, disposition fees, and revenue participation fees they would not otherwise pay with directly owned and operated real estate. The IRS requires that you replace 100% of your relinquished property with like-kind real estate. Certain uses of proceeds in a 1031 DST investment may not be considered real estate. As a result, if you do not add some additional cash to your exchange, you could have a small tax bill, despite investing all of your net sales proceeds and replacing all of your debt. Are 1031 DSTs real estate or securities? Well, the answer is both. But as securities offered under SEC rules regarding private placements, only a properly licensed financial professional can sell you DSTs, which are syndicated through a network of independent broker-dealers and RIAs. Our broker-dealer, Concord Investment Services, is one of the best DST brokers in the country. Risks of 1031 DST investing include illiquidity, lack of control, failure to meet 1031 requirements, underperformance of properties, inherent sponsor management conflicts and fees, leverage risk, transaction risk, and of course, general real estate risk. A property owned by hundreds of DST investors has no less risk than a property owned by a single firm. To help you delve deeper into 1031 DSTs, we have some valuable resources to offer. Our book, How to Retire from Being a Landlord, our properties page with multiple offering materials, our online literature library, and of course, you are always welcome to contact us directly at 1-800-445-5908. Thank you for watching.